This is Optimal Finance Daily, episode 977, 3 Steps to Determine If You Have Enough to Retire, by ESI of esimoney.com. And I'm Dan, I'm your host, and welcome to Optimal Finance Daily, where I read to you each and every day from some of the best personal finance blogs on the planet. And we always like to hear your ideas for future shows, so if you have topic requests, please do share them at oldpodcast.com. That's oldpodcast.com. And before we get to today's post, I want to thank Fundrise for their support. Fundrise enables you to instantly access high-quality, high-potential private market real estate projects, from high-rises in D.C. to multi-family apartments in L.A. And each real estate project is carefully vetted and actively managed by Fundrise's team of real estate pros. Fundrise is the future of real estate investing, so visit fundrise.com/OFD. That's fundrise.com/OFD to have your first 3 months of fees waived. For now, let's get right to our post as we start optimizing your life. 3 Steps to Determine If You Have Enough to Retire, by ESI of esimoney.com. I've posted a ton on retirement, including how to retire early, whether $1 million is too little to retire or not, and how $3 million is not enough to retire. But those posts tend to be how-tos with general suggestions. Today I'd like to get more specific and provide a roadmap for those wondering if they can retire or not, a way for them to calculate their numbers and see where they stand. So with that, let's begin detailing the 3 steps to determining if you have enough to retire. Step 1. Estimate your retirement expenses. This step sets the baseline for what you'll have to overcome to retire. If you've had a budget throughout the years and/or tracked your spending in any way, estimating your retirement expenses will be easy. You probably already have a good sense of what things cost and may have years of exact spending data to use in setting retirement costs. We have over 20 years of spending saved in Quicken, so this was a breeze for us. If you don't have any historical results, you'll need to get some eventually. So set up a system like Quicken, Mint, etc. to track spending and get some actual data. Until then, you can estimate by looking at past checkbook, bank, and credit card statements. Simply list what you plan to spend by category: food, clothing, home, entertainment, etc. over the first 3 years of retirement. Beyond 3 years is difficult to estimate. You can do this by year, quarter, or month and use whatever format works for you: paper, spreadsheet, computer program, etc. We use a spreadsheet and list costs by category and by month. Then at the end of each month, I save a new copy of the previous month's sheet, lop off the month that has passed, and set new projections based on more current info. This gives me a completely up-to-date budget every month and allows me to make adjustments where needed. Easy peasy. Doing this, you'll get an annual spending number. This will be your retirement target. Step 2. Determine how much retirement income you can generate. Calculating retirement income can be difficult since there are so many variables that go into it. I'll focus on the basics that likely apply to most people. These are: 1. Total assets less any debt on them. Obviously, the higher this number, the better. 2. The amount of income these assets can generate, or said another way, the income-generating return rate on these assets. 3. Whether or not you want to draw down on your assets in retirement. For example, using the 4% rule we've discussed here quite a bit. See my post, How to Retire on $1 Million or Less, if you want more specifics. And 4. Extra income from a side hustle. Once you know these, you can get a decent projection of retirement income. I'll run through a few examples to show what I mean. High income generating assets. Let's begin with Bob and Sally, who have the following finances: $2 million in assets, half in real estate and half in index funds. The real estate earns 8% in income per year, while the index funds earn 1.5% in dividends. Here's what Bob and Sally could earn in retirement. If they didn't want to draw down their assets, they would earn $95,000 per year. That's 8% on the $1 million in real estate and 1.5% on the $1 million in index funds. If they did want to draw down their assets, they would earn $120,000 per year, 8% on the $1 million in real estate and 4% withdrawal on $1 million in index funds. Not bad, right? They have a good amount of assets and a good return rate, especially on the real estate, which allows them a healthy retirement income. Lower assets and lower returns. Now let's look at Ben and Sue's financial setup. $1.5 million in assets, all in index funds. The index funds earn 1.5% in dividends. Here's what Ben and Sue could earn in retirement. If they didn't want to draw down their assets, they would earn $22,500 per year. That's 1.5% on $1.5 million in index funds. If they did want to draw down their assets, they would earn $60,000 per year, 4% withdrawal on the $1.5 million in index funds. Their assets are lower and they don't have any that generate high return rates, so their income is much lower than in the first example. Low assets and low returns. Now let's look at what Bert and Sarah have available. $750,000 in assets, all in index funds. The index funds earn 1.5% in dividends. Here's what Bert and Sarah could earn in retirement. If they didn't want to draw down their assets, they would earn $11,250 per year, 1.5% on $750K in index funds. If they did want to draw down their assets, they would earn $30,000 per year, 4% withdrawal on $750K in index funds. Fewer assets and lower returns equal lower retirement income. Low assets, low returns, and a side hustle. Now let's see how things change if you add in a side hustle. So same example as the last one. Bert and Sarah have available $750,000 in assets, all in index funds. The index funds earn 1.5% in dividends. Only this time they also have a side hustle that earns them $20,000 a year. Here's what Bert and Sarah could earn in retirement. If they didn't want to draw down their assets, they would earn $31,250 per year, 1.5% on $750K in index funds, plus the side hustle of $20K. If they did want to draw down their assets, they would earn $50,000 per year, 4% withdrawal on $750K in index funds, plus the side hustle of $20K. Big difference from their non-side hustle results, huh? This is why having a side hustle can make such a huge difference in retiring both faster as well as with more retirement income. I think you get the idea. There are a myriad of different outcomes based on various levels of assets and what those assets could earn. This is why you need to use your own numbers to calculate your specific returns. Once you do calculate your numbers, you'll then want to add in any other income, like from pensions, annuities, post-retirement work, businesses, part-time work, etc., to get your total retirement income. Step 3. Compare income to expenses. Now compare the numbers from the first two steps. If income is greater than expenses, you are ready to retire. Of course, you want to leave yourself some margin of safety, so the wider the spread, the better. If the expenses are greater, you still have some work to do. Options include 1. Save more from your current income and add to your assets. 2. Redeploy assets to get a higher return rate, one that gets you closer to covering expenses or even puts you over the top. And 3. Develop new sources of added income or make current ones higher. For example, start a side hustle or invest in one you already have so it churns off more income. Once you get to the point where income is higher than expenses, you have enough to retire. You just listened to the post titled 3 Steps to Determine If You Have Enough to Retire by ESI of ESImoney.com. And thank you again to Fundrise for their support. Come by fundrise.com/OFD to have your first 3 months free. Private market real estate has historically provided excellent ongoing cash flow even as it supports long-term growth. Private market assets like these are a strategy for diversifying beyond public market investments and even other kinds of real estate like publicly traded REITs. And Fundrise is the future of real estate investing. The platform's innovations power an investor-first model by eliminating the bloated costs and middlemen that have traditionally weighed down real estate investing, saving investors time and money. That's why it's frequently mentioned as a recommended tool in the blogs that I narrate here. Unparalleled transparency and real-time reporting let you see how the development of specific properties impact your overall portfolio. So come check it out. Visit fundrise.com/OFD. That's fundrise.com/OFD to have your first 3 months of fees waived. And that's it for today. Thank you so much for listening. Have a great rest of your day, and I'm going to see you back here tomorrow, where your optimal life awaits.